Okay, cool. Welcome everyone. I'm Wilson. We're here with T11 and Andrew. This is a very informal Twitch thing that we just started doing last week. Last week, T11 and I looked at Squeeth and tried to think of a good vault idea, and we're just stymied. And so we then went through the code, and then we were confused on some things, and so we were like, you know what? We should just do this again with somebody from Open here. So I don't want to assume people have too much Squeak knowledge, so we'll kind of go through things at a high level. But first, Andrew, I don't know if you want to introduce yourself a little bit. Curious to hear how long you've been at Open and a little bit about your process and or your role in getting Squeak out.
Yeah, sure. So I'm Andrew. So I head research at Open. And what that really means is kind of working on designing primitives and products like this, kind of building the mechanism, and then also kind of helping with some of the coding and stuff. So yeah, basically I joined Open in June of 2020. So I've been there for a while. Um, and then yeah, worked pretty kind of heavily on kind of the development of Squeeth and like the PowerPerp framework. And I would say I'm a mediocre Solidity coder, but I did help with some of the coding on this. So I think I can help out kind of from both like some of the technical side of things, but also on some of the financial and sort of mechanism side of things.
Sweet. Yeah, I'm excited to get into it. So I think I will first just kind of present the code base and we can kind of walk through Squeeth first and how it works. Let me see if I can first make sure I have this code here. Okay, here we go. Okay, so can you guys see the code? So here we have Squeeth, the controller for Squeeth, and the way it basically works is, and then so I'll talk, and then Andrew, you can correct me as I say wrong things. Um, so first you have basically people deposit ETH and mint what is called power perp or W power perp, which is conventionally known as Squeeth. So when you deposit ETH, you can specify how much W power perp you want or how much power perp you want. Um, if you do just power perp, it just divides it by the normalization factor when you actually go to open the vault. Here, let me click down there. Um, I'm curious, Andrew, actually first, if there was why you guys even wanted to like have the non W power perp minting ability.
Yeah, so the main idea was like, so one kind of fundamental thing to understand about the system is like the normalization factor should go down over time. And so basically what that means is that like over time, you should be able to mint more like O Squeeth or W power perp per like amount unit of collateral. And so like basically the difference between sort of like specifying a power perp amount and a W power perp or like an O Squeeth amount is basically like absent any change in the ETH price, like the price of O Squeeth should go down over time. So that's kind of like the way that funding kind of manifests itself in the system.
So is it mainly
And
for convenience on burning the same amount that you don't have to think about, or yeah, like what's the convenience in allowing people to not put in that amount that is like deteriorating and just put in a power perp amount?
yeah, so it's probably most useful for minting to put in a power perp amount. It'd be kind of like if you want to do like a sort of like a dollar amount, like
I
and
see.
like the W power perp like should like decay in like its relative um amount relative to ETH. So like
Yeah.
so yeah, so that kind of deviation, it's kind of just convenience, and maybe it's like someone wants to specify um an amount that's kind of more related to like a dollar amount, and then it can calculate how many units you need to do for that.
Okay. So yeah, when you're minting non-W power perp, if you're just minting power perp, you can you might be passing in something that's like strictly a linear function of like ETH squared and the collateral ratio, and don't have to think about the extra amount you're getting because of the normalization factor.
Exactly, yeah.
Okay. Cool. So yeah, so basically what happens is you when you deposit uh if we jump down, so yeah, these mint W power perp, mint power perp, these two things that I mentioned. So this is opens a deposit, and you get a vault, and you also get an NFT for this vault. And this is one question I had as well. Sorry, I'm getting like sidetracked as we go through the high level, but may as well get into these things. In the Uniswap world, you sort of have like in the Uniswap V3, you have the periphery has the notions of NFTs, and the core has the notions of LP positions, but does not associate those with NFT ownership. And I was wondering if you guys had a specific reason for having the core controller aware of the fact that these vaults are modeled as NFTs.
Yeah, I mean, I think one of the things that we kind of did with this, so if you like compare this to like our Gamma code base, which is kind of the code base that's used for like kind of traditional options, and like a lot of like the option vaults and stuff are using that. That was like a very kind of um, an architecture that had like it's kind of a lot of spokes. There's like a controller, there's like a margin pool, there's all these different contracts, and so we did kind of look, I think, from this perspective to try to simplify
Yeah.
um, the kind of the contract setup here. So I think that's kind of one of the aspects of bringing that all in there. And yeah, it's definitely like a smaller code base with kind of less upgradability, less sort of governance, adjustable params, things like that compared to the other code base. So
Oh, oh, sorry. People have been saying that we can't hear, they can't see the code. I'm sorry, guys. Um, Ignore this. Really sorry, everybody. Okay. Um, thanks for thanks for letting me know. Um, okay, so yeah, okay, so we're that makes a lot of sense. Sort of trying to keep the surface area simple, and so and maybe just let me hop over to the vault lib. So the vault is basically this struct here. You have an operator that is sort of like the operator for the NFT, but it's a little bit different. Basically, like to add to the position or certain things in the controller, it's going to check whether this operator is allowed. So you can permission another address to modify your vault. NFT collateral ID is specifically a Uniswap LP position that you could add for collateral to increase your ETH collateral. Collateral amount is just the amount of ETH in the vault. And then the short amount is the amount of W power perp that's been minted against your ETH. And basically, you have to, as a vault, you have to stay above 150% collateral ratio. So your debt value in ETH, if you convert your W power perp, your short amount to an ETH value, that has to be, 75% of your collateral amount, or, you have to have a 150% collateral ratio. And so, yeah, we can, we could go through as many of these in detail as we want to, but, it might get a little bit tedious. I think one of the things that's super interesting to me, I've been like very captivated by Squeeth, and I was trying to think about why. And, one thing I would actually try to write or something is like the game theory of Squeeth, because a lot of people, I'm used to thinking from the crypto standpoint of like game theory, and a lot of the Squeeth explanation has been from like a formulaic point of view. But I think what's really interesting here for me is that one, you don't have off-chain oracles. So you don't have anybody like calling in to tell you what the price of ETH is to update these things. You just are using time-weighted averages coming from Uniswap pools. And second, so you have this relationship on for funding. And so I think the general thing for perps is like mark minus index is the funding. So the mark is the price of the instrument. So that's Squeeth in our case. And the index is the price of ETH squared, the thing that it's supposed to be tracking. And you expect the mark to trade above the index because people are paying for access to the underlying instrument. Um, and um, and that's effectively amount that the longs are paying to the shorts. Is that sort of an accurate summary, Andrew?
Yeah, yeah, yeah.
And so, naively, if somebody asked me to like write code for Squeeth, I would think about like, okay, how, so the longs have some position and model like the timestamp when it started, and then over time, when they withdraw, you sort of deduct the amount that was accrued. But what Squeeth has is really clever. So it has this normalization, which is used to basically force the price of Squeeth down, such that your W power perp that you've minted in your vault, the amount of ETH that is worth is getting less over time. So over time, assuming a constant price in ETH, over time, you can mint more W power perp from your vault, or you can take some of your ETH out. And that is how the shorts are getting paid for this. And so the same sort of the mechanism that is tracking what the value of this instrument should be is the exact same mechanism that's tracking the payment from the longs to shorts. And so I want to go into the normalization stuff in detail because it took me a lot of looking at it. But I hope that wasn't too much of a word soup. Does that kind of make sense, Andrew and T11?
I think it was a pretty good overview. Yeah, from my side, but I'm pretty familiar with it as
Right,
well.
right. T11, any thoughts or comments so far?
Nope.
Makes sense.
Yeah.
Cool. So yeah, let's hop down to the normalization and let's see. So get new normalization. Okay, so let's just walk through this to begin. So you have a period. So the last funding timestamp, this is just set when the thing gets initted. And then they just cast this to uint32 because, well, this probably could be like a uint24 or something, but this goes to the Uniswap oracle, which takes a period of uint32. So then period for oracle, that we don't care too much about that. That's just for fetching the price, cash normalization factor. So get normalized mark. So this is going to get the use the Squeeth WETH pool to get a price for Squeeth. So it's getting a ETH price in USD, right? Or yeah, this is USDC. And this is scaled down by 10,000. And then you have the WETH Squeeth price, and then so they're multiplying the WETH Squeeth price by the ETH USD price, USDC price. So basically, like if the team had assurance that the USDC Squeeth pool would have been super liquid or something, they could have maybe just used USDC Squeeth or something here. But basically, they're getting a USDC Squeeth price. And then it's divided by the normalization factor, which, correct me if I'm wrong, we're going back to basically the unadjusted. This should be like the pure mark price. This should be the price of ETH squared, removing the fact of this decay from the normalization. Because if you think about just naively, you're dividing out the normalization factor that's sort of been computed in all of this Squeeth that's been minted so far. So we're trying to get to a pure mark price so that we can have a pure mark index comparison to get to that like perp formula of pricing. So then we have a get index, which is getting a scaled down index. I believe it's just it's ETH squared divided by 1E4. And the reasoning there is just that like you guys didn't want Squeeth to trade at like $1 million or whatever, so you guys scaled everything down by 10,000. Is that right?
Yeah. Like no one wants to have like 0.0001 Squeeth in their wallet, and Yeah, humans don't like decimals, I think.
Yeah, the what do they call that? The unit bias. I think we should just, go 1e8 or something. Let's take it down further.
Yeah, exactly, right. 10 by 10,000 squeets.
Right. Sorry, I'm gonna check on the stream just a second to see, make sure nobody's telling me anything. Uh, I came here to hear T11 talk. T11 is welcome to talk whenever he wants to. So let's see. Um, yeah. So okay. So we get the index. Okay, and so this is where things get interesting. We're also dividing the funding, the period that we're looking at by the funding period. Why did you guys do 420 hours for the funding period? By the way, any reason? Just name
Very
value.
scientific analysis. No, it was so there's I'll tell me if I get too technical, but there's like a trade-off in terms of this funding period. So in terms of like how large or how small you make it. So kind of the main thing is that Mark should trade really close to index with a very short funding period. You can think of a funding period as like how often Mark minus index is paid. So if you have a very short funding period, Mark minus index is paid every hour or every 8 hours. And so that means that amount the difference between Mark and index should be pretty low. Where if you have a very large funding period, like ours is 420 hours, that the Mark minus index should be larger because it's paid over a longer period of time. And so you can kind of think about that. So one of the main considerations is like, if you look at trading something on Uniswap, maybe you have a small amount of price slippage or some price impact. If you move Mark minus index, by 0.5% or something like that, if your original Mark minus index was only 0.5% difference, then you're basically doubling the funding by just doing a trade on Uniswap. So basically, like the closer Mark minus index are to each other, then the more like price impact has on your funding. So one concern we had was if we did a really small funding period, normal trades on Uniswap would cause funding to like swing from, like 0.1% a day to 2% a day to negative 0.1% a day. So it helps like with kind of funding stability. And there's kind of maybe a middle ground there that's kind of advantageous. And it was a good meme.
And smaller numbers in general are just kind of tough to deal with for fixed point math, right? Like even if you have a big scalar, you're increasing precision loss.
Yeah, that's actually fair.
So yeah, we have our funding period here, and so then you have lower bound. So basically, they're bounding the difference that the mark can be from the index. And I think there's actually a typo here. So you guys have a lower mark ratio. I think this is supposed to be 140%, right? Not 125%.
It is 140%. Yeah.
Yeah.
Maybe we didn't get that comment.
Yeah. So go ahead, T11.
No, I just said nice. Finding the bugs the auditors can't.
The typos. I'm a typo contributor. I also have the urge to this is also odd because it's like this is I want to go like this. But anyway. Okay, yeah. So if we go back down, so it's basically saying, if the mark is too far off of the index, just bound it, which is protecting, I guess, both shorts and longs. If it was under, well, I guess we should talk about that. So we expect mark to trade over index in general, but what does it mean when mark is under index? Basically, yeah. Can you talk about that?
Yeah. So I guess yeah, I mean, the reason that Mark should trade above index is because the payoff of Squeeth is convex, which means that it's like curvy and it looks like this. So basically, like what that means for a person is like when ETH goes up, you do better than how much you lose if ETH goes down, because it's like always better like as it goes up. So that's kind of like what you have to like intrinsically pay for like a structure that is convex. So that's like kind of the first thing. So one thing is that if Mark is trading below index, there's kind of like a free arb because you can basically buy Squeeth and sell ETH and get like convexity for free or get paid to have this exposure that's convex. So really like from like a mathematical or like a finance perspective, there shouldn't be a reason that Mark should ever trade below index. And there are people on our Discord that have realized this and they're like, if I ever see a trade under there, I'm going to like put all my money in and buy it up. But, you know, still there's kind of like supply and demand. And, you know, if someone sells a large amount, it's possible that Mark could go below index. And it's like a free floating sort of funding system. But yeah, there really shouldn't be a case that it does trade for any, you know, long period of time.
Okay. Yeah, that makes sense. Somebody asked why have 17.5. If you can point to a line number or something, I'm not exactly sure what you're asking there. So yeah, so it's being protected. So if it's over 140% above, it's just going to set it to this upper bound of 140% above. If it's under, I think it was 80%, it's going to set it to the lower bound. So here, then we finally get to this formula. So you have, you divide index by mark. So again, you're dividing the ETH squared price by the price of this instrument. And again, we expect mark to be above index. So normally this is going to give us a value that's less than 1 under normal conditions. And then we take the log. So this is one thing that I got confused about reading Joe's, one of his Medium posts. He has log n. And I was just playing with this in Excel. I get different results of log base 2 versus log n. And I see you guys have log n here. Maybe it's going to be too technical to get into it. But is there anything worth mentioning there?
Yeah, I mean, I think there's like a lot of different ways you could choose to do this calculation. So I don't think it's worth necessarily hanging up on the exact way. I mean, the main way you can think about it is like you pay some percentage, like mark, like the most simple way to think about it is like you pay like mark minus index over some amount of time. There's some complexities about like how you want to do it in a way that doesn't overflow or underflow. And you want to do it in a way where, yeah, you don't have like the funding it can blow up if the contract's not like touched for a long period of time. So like there's very, very small nuances, like nuanced differences in terms of like how you could actually calculate it. But like this way for us gave us like the best balance of like accuracy as well as like safety from the standpoint of like overflows, underflows, and it won't brick the contracts if like it's not touched in it, like, you know, like, I don't know, a couple months or something like that. And like funding's not, because you can have like very large numbers that accumulate over that and things like that. So it's kind of the main rationale there.
Okay, cool. So yeah, and we can get into some sheets for this as well. But basically, like at the end of this, I mean, I almost want to say that the normalization is like monotonically. I guess we're getting the Squeeth is getting smaller, so it's the normalization, but the normalization is getting smaller as well. Yeah, but it's not quite monotonic because we could have these blips of odd funding or whatever.
Yeah, and it's also multiplicative because it's like a norm factor times the old norm factor. So if you really like graph it out, even if it's like a constant funding rate, it's like curved, you know, downward, like asymptotically like approaches 0 over, you know, however long it takes basically.
So are you guys gonna have to like, you know, is O Squeeth gonna have to be reissued at some point? Is it, you know, in 2 years it's gonna be like worth $1 or something?
I mean, yeah, it might have to, or maybe that's the unit bias thing that works well in this, you know, like, you know,
Yeah.
you're buying them, you know, Squeeth eventually.
Yeah. Okay. So yeah, the notion is that, you know, every time this contract is getting touched, you're updating this normalization factor, and the normalization factor is what is being used to compute how much W power perp can be minted for ETH. And so every time this decreases, it looks like you have basically effectively been paid ETH in your vault. You've been paid back some ETH. And you can now take some ETH out of your vaults and have the same original collateral ratio as you had targeted before, again, assuming a constant ETH price. Or you could mint more Squeeth. Yeah, so I think this is quite clever. I had a sheet where I was playing with some of this, but I sort of mentioned to Andrew maybe if we want to show any sheets or formulas to like build intuition for how some of these things change. T11, any questions or comments before we jump to that?
Nope. I thought the discussion about the log base was interesting because that's where the comment right above says log in and log two. But
yeah, it says it's like they're showing the expansion, and yeah, they have log n and then they expand it to log two. I also was confused by exponent two, which was not the binary exponent was not behaving at all how I thought a square was going to behave, and maybe I just don't know how these fancy math libraries work. Or is that just supposed to be squared, the exponent two?
I'm trying to remember exactly. I think that's just squared. Yeah, I mean it's basically like we wanted to like the multiplier, the comment there, that's like the calculation we want to do, but we didn't find any good libraries that could do, an arbitrary, decimalized, exponent or something like that, right? Like that, because this R funding can be something like it's just based on like what the period, like how many seconds have elapsed relative to 420 hours,
Yeah.
basically. And so, yeah, we basically had to, if I remember when we were going through this, like we just had to like kind of decompose this into, a variety of like log and exponents that can kind of result to this. But yeah, so I tried to show that there,
Cool.
but
well,
So yeah,
like
if you want to put up a sheet.
exp2 is 2 to the power of the number, not the number to the power of two.
Oh, okay. I just like looked at the code comment and it was like binary power, and I was like, okay, that makes a lot more sense why I was seeing these numbers, and it makes sense then. It's the inverse of the log.
Yeah, so that's the log n of x times r is the log term.
Yeah.
And yeah, it's due to that, basically.
Okay. Do you want to share a sheet?
Yeah, what do you think would be good to start with? I've got one that just kind of shows the norm factor we were talking about, kind of like how it might decay over time, and like
Yeah, sounds great.
Maybe we could start there.
Here, let me kill my. And anybody watching, feel free to chime in with specific questions. We will keep moving through the code. But okay, cool.
So this is just a kind of simple spreadsheet I put together that basically just tries to illustrate sort of what you might expect the Squeeth price to do, given basically these two things here. Like given like what do you think the ETH price will do every day? And this is a very simplified assumption, like ETH goes up 0% every day. And then like what is the daily funding, which is calculated actually based on these numbers up here. But like, so this is kind of illustrating like what might happen to I tried to do it pretty close to where Squeeth is right now.
Yeah.
But so I think like Squeeth is, or at least as yesterday, I don't know if I've got it exactly perfectly, but around 0.25 ETH per Squeeth. And then kind of like if ETH price never changes every day, then basically what happens is you have this normalization factor, which kind of decays. And so like, if you assume that this funding rate is constant, then kind of you get this sort of decaying value for Squeeth over time. And then, basically you can think about like how much ETH needs to go up every day to offset this daily funding. And so you can kind of think about them as like you have this negative force that's kind of dragging down the price of Squeeth, which is the funding and the norm factor. And then when you're long Squeeth or when you're long Squeeth, you basically want the ETH to move more quickly than the funding decays the product.
So when you compute the new normalization factor, so the diff between the new normalization factor and the old normalization factor is the funding change, I guess, or the percent change between them is the funding for that period?
Yeah, that's like a pretty easy mental model for thinking about it. Yeah.
Okay. Yeah.
Like
So
if
this is
Mark
what.
minus, oh, sorry, go ahead.
No, please go ahead.
Yeah, I was gonna say like if like Mark minus index is like 1%, you'd basically be paying out 1% times like the roughly times like the fractional period that has elapsed. So like
Okay.
number of seconds divided by 420 hours,
Yeah.
roughly.
Yeah. So, what Andrew just showed here with like the amount that the ETH price has to change for the daily funding to be overcome is super important because if you think about uh trying to make money as a short, this is like why T11 and I got caught up last week because as T11 said, like Squeeth is like a very sharp knife, and it's like you have to be very careful how you work with it because there's all kinds of ways in which you can get wrecked. Because if you let's say I open a vault and I sell my W Power perp and now I sell it for ETH and I'm now sitting in ETH. Basically, if ETH goes up or down a certain amount, I'm screwed because ETH depreciates faster than Squeeth. And so if it goes down too much, I now have to spend more ETH to get back the my Squeeth to pay back my vault. And obviously, if ETH goes up, Squeeth is going up at the square, and then I'm screwed as well. So, but the question is, how much do you get out of this funding? Like, how much does funding make the difference? And so I think we're seeing that here, where basically if like the ETH price changes within a certain amount, then the amount that you are getting paid from the decay and the normalization is overcoming any problems you're having with it, the price going up and down.
Yeah, and yeah, this one that I made was kind of focused on like the long case for like someone buying Squeeze. I also did one that kind of looks, I think it's actually just this tab right here. Yeah, yeah. So this one's like a little bit more on like this is like looking at like a short vault and thinking about kind of what's your return based on like some amount of elapsed time. So we could also talk about this one if you want to
Yeah, please.
dive into this one. Yeah, so basically this is kind of looking at like if you open a vault at some set collateralization ratio, the other stuff is basically like what is the current market, like what is the initial norm factor we have, how high is mark trading relative to index, what is the ETH price, etc. And then basically you can look at like, based on some collateralization ratio and some initial amount of minted Squeeth, what is kind of my return profile given this sort of funding rate over a certain amount of days? And so like, I guess basically one thing to like note that like we've kind of talked a lot, a decent amount about on like Discord and stuff, and there's been a lot of questions about this, is like around 200%, it's not exactly 200%, but around 200%, it's usually slightly higher than 200%. You basically like, if you open a vault at 200% collateralization ratio, slightly higher than 200% collateralization ratio, you basically like don't have any exposure to the price of ETH locally. So like if ETH goes to 2,501 versus 2,499, you like really don't make or lose money. But in all cases, you basically make or lose money if there's large deviations. And that's like from this convexity. And then basically, so from a short perspective, you basically make money over time, which is basically this decay in the Squeeth price. And basically, as a short, over time, the sort of break even to either side gets larger. And so this is like a lot of people that have been shorting do things similar to this, where it's basically, I think that, over 14 days, ETH is not likely to be, higher than 3,100 or lower than 2,200 or something like that. And so you can kind of think about like, what is the break even given what the funding will be? And that's kind of a one thing you can think about in terms of like, is this a good thing to short or not?
So, but this is showing so just trying to understand what I'm looking at here. Where is this positive? Like, where's the 14-day positive? It's positive between 2,000 and 3,000, and that, so if ETH is trading in that range, then you're positive.
Yeah, so it's like 3,000, 14 days, like 3,000 to 2,200 maybe, something like that.
And that is assuming an initial price of 2,600 right now.
Yeah.
Got it. Super cool. I have more questions about this, but T11, any thoughts or comments on this?
No, go ahead.
Yeah. So you're saying a vault here, because T11 and I were sort of talking about this last week. You basically like would pick a collateralization ratio, and you would pick that based on the current price. So you'd say like I'm going to be at 200%. I'm going to mint that at the current price.
Yeah. So, I mean, the way, and I can talk a little bit about like Crab, which is kind of a vault strategy, if that's also
Yeah,
helpful,
let's
like kind
let's
of
hold
what we've
off on
been.
that because I want to hop to the code there and get into that in detail.
Okay, sure,
Or
sure,
I
sure.
mean, if it's helpful, you can allude to it here, but
No,
let's.
no, we can, yeah. So yeah, I mean, I think the way I would think about it is like you can probably calculate what CR you want for your strategy. And so like, I mean, I'll just illustrate what different CRs do. Like, let's say I do a CR of 300. It's like, oh, I'm now kind of long ETH, right? And so like I do badly if ETH goes down, I do good if ETH goes up, but I don't do as well. And I start actually like doing badly if ETH goes up too much, right? So
Yeah.
like your choice of CR, if you do a really uber risky one, I don't recommend that, you'll get liquidated instantly, but you can even do things where you're slightly short the price of ETH based on like the CR.
Cool.
So like, yeah.
I'm sure people would love to play around with this too if you feel comfortable sharing it in the Twitch or on Twitter or whatever.
Yeah, definitely.
Yeah, so super interesting. And so I think one thing before we hop over to Crab, I think one thing with this mechanism again that's very interesting to me is that like nothing is the only thing that's forcing the price to go down is the fact that people can mint it at a lower value now. so like if I mint it and I sell my Squeeth, and if I'm like the only person in this universe who did this, and now the normalization factor goes down, well, like Squeeth might not trade down, right? Because you need to have a liquid market of people depositing and selling at like close to the current collateral ratio to take advantage of the decay in the normalization. So one thing I'm curious about is like, how did you guys think about getting kind of all these things spun up concurrently? And did you have any fear of like, oh, if we lack liquidity on the Squeeth side, or yeah, what kind of work did you guys do there?
Yeah, I mean, yeah, so I guess, yeah, definitely it's always a little scary, like kind of this is like kind of a new mechanism, I think, in some ways, like or it's like definitely like a unique way. It like is related to a lot of other things, like it takes ideas from a lot of different things. But yeah, definitely always like worrisome. It's like, is the funding working as well as it should be? And we've definitely seen over a couple weeks since launch that like funding was pretty volatile at the start. Like there were a lot of buyers coming in, pushing the funding really high. Sellers hadn't quite figured it out yet, I think, at the start. But things have kind of calmed down a little bit, I think, and so that's been good. And it seems like the normalization factor has been successful in forcing the price down, the Squeeth price down over time. So it seems like the mechanism is working. So like one thing that you would get is if basically if no one pushes, no one provides that pressure to the price of Squeeth, you would basically get something where your like funding keeps going up. Because if you remember, to get that mark that we use to calculate funding, you divide by the normalization factor. So if like your price of Squeeth never changes, your mark just gets higher and higher. And it like means that like the force pushing it down increases over time. But we're not really seeing that so much. Like vol hasn't just, or funding hasn't just, been unbounded. And it seems like things have tracked fairly well, kind of the decay and the normalization factor over time.
Is this the first, like, what's the history of like protocols doing this sort of in-kind funding? Have there been others?
Yeah, I mean, so I think like rye has some similarities to this in some
Hmm.
ways. It's not, I wouldn't say it's exactly the same. I mean, it's similar in some ways to like MakerDAO CDP. In some
Yeah,
ways,
this to me feels like one of the most like eye-opening things since MakerDAO CDP because of like the cleverness of um, Maker is very clever, but Maker, these things are a lot more obvious. Sort of like, if things go over, you sort of auction them off, and you can sort of like there's just a price that's accumulated linearly to how long you've had that die. Um, Whereas this is just so much more implicit. It's like all based on this trying to force the price down and hoping that the Uniswap pool plays along with you nicely. But sorry, I didn't mean to cut you off.
oh no, yeah. And I guess I can share like kind of some of the maybe I can like dive a little bit into the mechanism of like um how the price moves lower if that's helpful. Like because there's actually like there's an interesting mental model for like how you monetize. Because you mentioned there's like different ways you can monetize funding as like a short. You can like take ETH out, you can like mint and sell more. So there's
Yeah.
like different ways. Maybe that's interesting to walk
Yeah,
through.
yeah,
But
definitely. I think T11 unmuted there for a second, but yeah, let's get into that.
oh, okay, yeah. And then I'll just real quick. So yeah, so like as you mentioned, like so most directly, like funding is accrued by like the price of Squeeth going down, Squeeth going down. So if you're short Squeeth and you can buy it back for less, then like you can make money based on like your sell price and your buy price, right? The price of ETH doesn't change, your collateral value doesn't change, and Squeeth goes down, then you monetize some funding by doing that. Like the main reason you do that is if you put the short on at a high funding rate, and now maybe the funding rate is lower in the future, and you don't think the funding is too high, and maybe that's when you want to buy it back. Another way is like you take ETH collateral out. Kind of what that effectively is it's kind of like you're slowly taking your trade off. So you put this short on, and then over time you're just taking ETH collateral out. It's kind of like you're just slowly reducing your trade. Maybe that might be like best in a time when you think like the funding is maybe fair. You don't like want to just like close the whole position down, and you don't want to like add more. That's maybe when like the best time to monetize funding that way would be. And then if you mint and sell more, that's kind of like keeping like adding to your position. Like you keep like putting more exposure on, and that's kind of like if you think the funding remains high and want to keep yourself exposed to the funding. So there's kind of like nuances in how you manage the position as well as kind of like what your view of like is funding fair, is funding too low, is funding too high. If you're like an individual managing the vault.
Yeah, super interesting. Um, there's some questions, or there's a question in the chat, but T11, go ahead if you had something you want to say.
I was just gonna say that the reliance on arbitrage and like all of that compared to like Maker, all the moments that require arbitrage more directly, like in the system, are like are like explicit auctions, right? Like that there's
Yeah,
and it's very clear, and there's like websites that can show like there is an auction right now. We need people to participate.
totally.
Whereas like it's just, like nowadays, there's more systems that like are just like we expect kind of continuous action by people to like make the protocol work.
Yeah,
And I feel like it might even be enabled by like all the improvements we've seen in MEV efficiency from like flashbots and all of that, right?
yeah,
Yeah, I think so.
yeah,
Definitely.
and I think it seems like the time weighted price average with Uniswap v3 is also just a game changer.
Yeah, that's a great point. Yeah, it feels like that combination of being able to just kind of like as ETH price goes down, there's bots that are like arbitraging like 40 different protocols in one transaction and doing like a chain link price update. And then you also have the reliability of the reliability of the TWAP oracles. Like they're always up to date.
Yeah, yeah. So let me try to ask one question here from the chat. Somebody said, "Is Squeeth mathematically the equivalent of being long gamma and paying for it through theta?"
Yes. I would say the simple answer, yes. Yeah. So
I'm glad that made
Squeeze is
sense to
like
you because it does not make any sense to me. But
yeah. So yeah. So theta is you can think of theta, it's like an option term that means like decay due to time passing of an option. So you like lose, an option loses value over time
Yep.
due
Oh, I get it.
to,
Yeah. Okay. Yeah.
and so funding is the equivalent of theta,
Yep.
and gamma, Squeeth basically has like a constant gamma, which is this convexity that you have, and gamma is just like the curvature. So Squeeth, yeah, so Squeeth is basically you're buying this curvature and you're paying funding for it, which is like gamma versus theta.
Okay. It seems like intuitively something that would be useful is like if you have some lower bound on funding rate, like I think it'll be at least this every day. Then you could start to work towards like where you're comfortable being short and long. Because I think I haven't had, I've struggled to have any intuition for like if ETH changes in this, this much in these many days, how much how much is my decay going to pull against this price change? And without that, you don't really have much confidence opening a vault or whatever. Um, what's interesting, right, is that you're more concerned about ETH going up than down, right? Because it's a 75%. It depreciates. Yeah, the rate changes depending on which direction it moves.
So when you mean when you're short, when you have a vault that's short,
Well,
or
I guess what I'm alluding to there is I think you guys said with the crab, and maybe we can kind of work towards getting into the crab strategy that if ETH if it's less than plus or minus 6% in a day,
hmm,
but that struck me as odd because the mark should depreciate more slow. It should move more slowly on the downside. So I would expect it like plus 6%, minus 2% or something, or rather more leniency on the downside, because yeah, your mark is going to increase exponentially on the upside, but is only going to depreciate at 75% on the downside. Does that Am I making sense at all?
so it's, I mean, it's actually, it comes back to basically like this is what crab is. Crab is like you have something where initially you try to create this sort of symmetric exposure, and so crab like tries to have this exposure on a daily basis. Um, and so basically you have sort of some break even on either side here. And so it actually tries to create like a symmetric break even basically. Um, so you can think of like, just pretend the red line is like one day, but basically it tries to over one day, plus or minus X%. And that whatever that X% is can just be calculated and determined from like what the funding is over that period.
Okay. And I got a note that my call is expiring. I'll see if I can upgrade my Google Workspace. Otherwise, we might have to start a second hangout. But yeah, I think what I was thinking, just to tease this out a little bit, and then I promise everybody we'll get to looking at more code and crab, is like if I if I deposit in a vault and mint Squeeth, if the price starts to go up, I get really nervous because it's going to cost me more to buy Squeeth. To let's say I sell my Squeeth and I need to buy back to close my vaults, and Squeeth is appreciating at twice the rate of ETH, and so that's very concerning to me. If it depreciates, I'm also concerned because I'm in ETH and that depreciates faster than Squeeth, but it's not the same relationship as the upside. Squeeth isn't ETH isn't depreciating at the square of Squeeth, whereas Squeeth is appreciating. So that's sort of what I was trying to get at, of like more tolerant for downswings than upswings.
Yeah, I mean, well, certainly it's more tolerant because you can only get liquidated on short Squeeze if ETH goes up. So that's
Yeah.
one thing that's also, so yeah, you're only scared about liquidation from ETH price going up standpoint. Yeah, I mean, I guess an important thing that I didn't really mention also for these is like when you deposit into something with this sort of exposure, like what you're trying to get is a dollar return. So these like percentages, like you're not trying to like increase the amount of ETH you have. This is like, I'm trying to earn more dollars based on the dollar value of ETH I put in at the start. And so that's also like an interesting thing. It's like, this isn't like I'm going to like stack ETH strategy. This is like, I put in $1,000 and I hope to have, more than $1,000 in the future from this trading strategy.
Okay. Um, I think this is going to kick me out of this meet. So let me see if I can start another meet and have us over there. So give me 10 seconds to start another meet. What is showing on the, oh, this is going to, let's see if I can. Let's see. Mute myself over here for a second. I'm going to drop this in our chat here. And if you guys just want to try to hop over there, then we should be good. All right, I think that worked. Okay, I think that worked. Let me know if anything went wrong on the stream. Can one of you guys talk for a second?
Hi.
Hello.
Okay, I think it's still working. Okay, sweet. So let's check out, or t11, you just shared an Etherscan. Did you want to? Oh, this is like the ARB stuff. Yeah.
Yeah, it's just like a massive like 10 liquidation arb, and like that didn't used to happen earlier
Yeah.
until like the advent of flashbots and Mev got super competitive.
Yeah. Okay, so yeah, let's I'll pull up the crab code, and then yeah, Andrew, do you want to talk about it at a high level first?
Yeah, sure. So the crab basically tries to, on that like little parabola chart we had before, tries to like create an exposure that doesn't take a view on if ETH is going to go up or down every day, and just tries to basically, it basically is taking, by like putting money in the crab strategy, it's kind of taking the view that like the funding that's implied on Squeeth, it's like you can see on the contract from like the market index price is higher than how much ETH is actually going to move around. So it's kind of like taking the view that ETH is going to move less than Squeeth is than the mark price of Squeeth indicates. And it basically tries to make like a dollar return by basically earning funding and then rebalancing itself to have no ETH exposure like every day, or if there's like a big enough of a price deviation. That's kind of like
Okay.
super high level.
Yeah. Yeah, I'm excited to get into some of that. I'll kind of start from the top. So um there is this flash deposit where basically somebody is depositing ETH, and they are buying W Power Perp with WETH, and then in the or wait, no, they're selling. We're selling W Power Perp, yeah, with WETH. And so and I believe in the callback, you both get the WETH, or do you need to get the WETH, or you just need to get the W Power Perp?
Yeah, so basically like the way we do it, the reason we do it this way is to mint some Squeeth, you need some ETH, right? So if a user deposits 5 ETH, basically, and then they mint some Squeeth and then sell it, they get ETH back from it. But ideally, we want to use the proceeds from their sale as collateral in the system as well. So basically, the idea of the flash swap is we get the ETH from Uniswap from doing that sale beforehand, and then use it to collateralize the vault, and then we mint the OSqueeth, and then we repay the Uniswap pool. So we basically, it's like you get the proceeds of your swap before you pay for it, and then you pay for it at the end once you've minted.
Yeah, so sorry, maybe this is what you were saying, but I'm still not totally clear. We talked about this a little bit in Discord. Why not, like, you have ETH to begin with. Why not just before the flash deposit that in the strategy, get your W Power Perp, and then in the callback, just send the W Power Perp? Not that it really matters, but just.
Yeah, the main reason is it's just like it requires a person to have more ETH than they would otherwise need.
Oh,
Because yeah.
oh wait, no, say why.
Like it's like let's say you deposit 10 ETH and then you
Yeah,
can sell, I'm just random numbers. Like let's say you
yeah,
deposit 10 ETH and can create one Squeeth or something. And
yeah,
then you sell that Squeeth for 5 ETH.
yeah,
So at the end of the transaction, you've put 10 ETH in
yeah,
and you've gotten 5 ETH back. So really you only put 5 in, but you needed to have 10, right? So
yeah.
like we can just abstract that whole and make the user not need to have that extra 5 ETH basically by doing it in a flash swap.
So, okay, yeah, let's click into it. So we have this exact flash swap, and then this has this swap callback data, and this ends up going to um, where's our callback? Or I think, oh yeah, here's the V3 callback. And so if you're not familiar with Uniswap v3, basically it just says like, I trust you that you have some way to fulfill this. So it sort of optimistically makes the trade and then calls this callback and expects you to, at the end of that callback, Uniswap expects to have the balances that it needed to fulfill that trade. So if we go to strategy flash, we want the crab strategy flash. Strategy, or wait, it was underscore, wasn't it? Yeah. So this is for a deposit. So we expect we now have WETH from this trade. We unwrap it. Or wait, we withdraw it, and then we deposit. And this is an internal function. And then this is going to transfer the W power perp to Uniswap, which is expecting to pay back for it. So yeah, let's go through this again, and T11, you can jump in if this is making more sense to you. So somebody deposits 5 ETH and they optimistically sell W power perp, and then they on the callback we deposit that ETH, but it's not clear to me. You sort of said you needed 10 to mint one. Wouldn't you still need 10 to mint one, regardless of if you're doing it one way or the other?
Yeah, you would still need 10 one way or the other, but the question is like, can you use the proceeds of the optimistic sale for that ETH, or do you need to take it from the user? So it's like, let's say you need 10 ETH of collateral and to mint one Squeeth, let's say.
Yeah.
And let's say the price of an Squeeth on Uniswap right now is 5. So
Oh,
5.
oh wait, yeah, okay, yeah, go ahead, continue.
So it's like if the price of it now is 5, I know that when I sell, so like I could take 10 ETH from the user, mint one, then sell it for 5, and then give that 5 to the user. And so the user basically put in 10 ETH, and they got out 5 ETH from the sale. And so net, the user basically put in 5 ETH to like deposit into the strategy, right?
And then sold it. Yeah. Okay, got it.
Oh,
Okay.
so like they'd either be getting a refund. So the idea is they could either get a refund, or with the flash loan process, you can use what they get from the refund and kind of put it back in.
Yeah, it's basically like you need a lot less ETH. Yeah, it's like using the proceeds from the sale to deposit into the strategy. Yeah.
Interesting.
Yeah, so the function is payable, but you're not actually sending that ETH to Uniswap. You are selling, yeah, and then depositing. So yeah, I get it. The rather than depositing, getting it back, selling, and then you have the 5 ETH at the end of it, you can flip the order, and optimistically sell it, and then yeah.
Yeah.
That is such a cool use of flash loans.
Yeah,
Yeah,
we're pumped to be able to put that in. Yes.
sweet. So and then we talked about this a bit last week. You guys also have this pure deposit function, which mints somebody both the crab strategy amount and the Squeeth amount, which T11 and I were looking at last week, and we were super confused because we think of vaults and you like deposit it, you get the strategy token, and the vault kind of manages all the other tokens. But here you're getting the strategy token and you're getting the Squeeth back. The simple explanation for why this is okay is that to withdraw it, you actually have to provide both back as well. So there's no free lunch of just withdrawing your crab token. But yeah, Andrew, I don't know if you wanted to mention anything you guys had in mind with those functions.
Yeah, the main idea is like, so flash deposit and flash withdraw, it's like it does the trading for the user as well. So user flash deposits, it like sells the Squeeth. Flash withdraw, it like buys back the Squeeth and then burns it against the vault. So it's like that's like fully automated like depositing, withdrawing. And I think for 99% of use cases, that's the one that makes the most sense. For deposit and withdraw, it would be more if someone didn't, let's say someone was depositing a large quantity into the strategy and they didn't want to sell their Squeeth in one trade because of slippage or price impact or something like that. Then they could use deposit. They could get the Squeeth themselves, and then they could sell it over the rest of the day or something like that in like batches or something like that. So this could be useful for like some use case like that, or it could be useful for maybe like if there were like contracts that wanted to like batch deposits together or something like that. If there was like something that integrated another contract on top of it.
Yeah, and just to click in, just so people, I'm not relying too much on people's knowledge. So if you look at this deposit, which is used by several of these things, Calix shares the mint, Calix W Squeeth the mint, and remind me, I want to come back to this Calix W Squeeth the mint. And then it mints the I think it's here, right? That it mints the W power perp. Yeah, so then it has this mint W power perp, and it has the question of whether you keep the Squeeth. And in the flash case, the strategy keeps the Squeeth, and in a normal deposit case, it doesn't. But this brings up a question for if I'm a whale and I want to participate in the strategy. You sort of said I can get my crab token out, and I get my Squeeth out, and I could sell it over the course of the day. How do I get into the strategy position of somebody who flash swapped in? Does that make sense?
Yeah, so pretty much if you do the deposit function, if you call the deposit function and you get the Squeeth and then you sell it immediately, that's like functionally the same as doing the flash deposit, with the exception that it's like less capital efficient because you put in 10 ETH, got this Squeeth out, and then you sell it for 5 ETH. It's like kind of
got it. So I'm ending up with the
functionally
ETH rather than the strategy optimizing that for me.
Yeah, it's just like slightly less capital efficient on the entering the strategy, but like functionally you can have like the same exposure either way you do it. It's more like a convenience function for certain use cases.
Yeah. Okay, cool. We lost T11 for a second. Let me make sure he didn't telegram me or something. Let's see. Okay. And yeah, feel free, anybody, to chime in the chat if there's particular things you want to click into. Otherwise, we'll keep going through the strategy. Okay, so does the strategy, it tries to stay at a certain, T11 is back. It tries, I figured it was something like that. Yeah, how does it manage staying at a certain collateral ratio? Or because I don't even see any, let's click into this calc Squeeth the mint. All I see that it tries to sort of stay and net the same position, right? So it says deposited amount multiplied by strategy debt over collateral amount. So it's basically saying like, given the current ratio of debt to collateral, mint me more according to that same ratio. So is it all implicit from that, or yeah, what's going on here?
Yeah, so this is basically when users deposit and withdraw, we like keep the ratio of debt and collateral in the strategy constant. So it's like they can't take money from other users and they have to deposit on the same terms. So that's just like around basically um, fairness and everyone basically has the same terms for deposits and
Well,
withdrawals. But yeah, so the actual rebalancing happens in different functions. So it'd be like time hedge or price hedge, or time hedge on Uniswap or price hedge on Uniswap would be the ones that where the rebalances
yeah.
happen.
Okay, so let's go into these because I'm like, why are there so many? You have all these things, right? That are like, is it a price hedge? Price hedging not allowed? Is time hedge allowed? So what's going on with all these strategy functions?
Okay, so there's two kinds of hedges. So a time hedge is basically every certain number of hours or seconds or days, any sort of time unit, the strategy rebalances itself and is eligible. So all of the rebalances are basically an auction. So it basically what it does is it figures out what the Uniswap TWAP is of the O Squeeth ETH price, and it basically starts if it's, let's say it's buying, it needs to buy some. So it always trades basically O Squeeth for ETH or ETH for O Squeeth. So it like trades on the Uniswap pool, and it basically figures out what the TWAP is, and then let's say it needs to buy O Squeeth, it will start an auction at like -5% of that TWAP, and then slowly over the auction period, it will raise the price until it executes a trade.
So which one of these functions does that use, or is that using all of these?
It's used in all of the functions. So the difference, time hedge is basically in this case, it's every day. Every day it hedges itself. Price hedge is if the price moves by 20%, it trades. And that's kind of just like more of a prevent a liquidation scenario, because if ETH price moves by enough, the strategy can get liquidated. So this is like preventing liquidation. And also it's kind of like cutting your losses. Like if you remember that parabola graph, like you lose money if ETH has a big move. So this is kind of like cutting my losses to prevent further damage.
Okay, so and T11 just said they have to go soon, but that's okay. We can continue for as long as we have interesting stuff to talk about. I'll T11 any things you want to comment on before you have to hop out.
No, I thought the flash loan stuff was really interesting. Otherwise, I think everything makes sense. I think the other important distinction was thinking about the crowd strategy is like, you're never trying to make ETH, like get more ETH. You're trying to just increase your dollar exposure. And that's where, like, when we talked about the kind of sharp knife nature of Squeeth, that's where it starts to make a bit more sense, because like, yeah, you get like, it's very sharp with ETH. Like you're pretty much always wrecked. But USD price, it seems like it's more like it's easier to kind of make kind of bets on that.
Yeah. Yeah, so with these strategies, is the current crab vault, is it all of these? Does it have price hedge available and time hedge available?
Yeah, so it does both of them. So it's every day it hedges, or if there's a 20% move in the
And
Squeeze
this is
price.
some non-Uniswap time hedge?
So the only difference between hedge on Uniswap or not is we create an easy way for someone to sort of flash bots the trade on Uniswap. So basically what it does is we have this auction that's running, and we know where the auction is. So maybe it's like the strategy is like, I'm going to buy one O Squeeth for 0.25 ETH. If the price on Uniswap is lower than that, then the hedge on Uniswap basically executes the trade on Uniswap and then returns the difference between the execution price and the auction price to the caller of the function. So it's basically like we
Yep,
basically
rewarding
create
somebody.
like a wrap function that makes it super easy for someone to like arbit on Uniswap, basically, and like extract a little bit of value for calling that function.
Okay. And so that's price hedge on Uniswap, and
time hedge on
this
Uniswap.
and this price hedge does not have that feature.
Yeah, so the ones that are not on Uniswap, it's basically
what is this on, or it's passed in?
So the price hedge would be like the user trading against it. So if the strategy wanted to buy Squeeth, the user would sell the Squeeth to them instead of just doing it on Uniswap. So it's like if I don't know, a market maker or someone wanted to sell Squeeth, it might be better to do it in this auction rather than trade it on Uniswap because you might get better pricing, for example.
Okay. So yeah, let's click into so is hedge on Uniswap, is this where kind of the magic happens?
Yes. Well, this is another flash swap.
So where are the features around? You mentioned like, this is sort of like ongoing, and if it's not getting the right price, it's going to adjust. Where is sort of like the state tracking that?
Yeah, so I think that's going to be start auction. Let me just double check myself. I'm trying to remember the exact function. Get auction price is one of them. One of the
it looks like start auction.
Yeah, okay, start auction. Yeah.
And this is some internal. So who's calling this?
It gets called in the hedge function.
Got it. So okay, so this is going to determine if it needs to sell or not, if it needs to sell or buy, right? All right, see you t11. Maybe you'll rejoin in a second. So this is going to determine if it needs to sell or buy, right? So the strategy has Squeeth to sell, right? But does it also have ETH to buy Squeeth if it needs to?
Yeah, so the strategy, what it is it's a vault that has some debt, some Squeeth. So it's minted and sold some Squeeth from every user that deposits and it's sold it, yeah. And then it has some ETH. So it has like ETH collateral or ETH like assets and like a debt in Squeeth. And so what it can do is it can like change the composition of those assets. So it can use some of its collateral to buy back some debt and burn it, or it can basically mint some more and sell it and then deposit that as collateral.
Got it.
And yeah, that's what like the flash swaps again are used for, is like optimistically getting those proceeds to allow us to like change the vault composition, basically.
Okay, cool. So, and I guess that happens in check auction type. It's going to sort of check which way it needs to go.
Yeah.
So here, collateral ratio to hedge, in target hedge. So where is the target ratio, I guess, you're trying to achieve that I'm trying to...
I think it's going to be in get target hedge and auction type. Yeah, that one.
Got it. Okay. Yeah, I guess I was expecting some like top level constants of like collateral ratio numerator denominator, but that's what.
Yeah, so it's basically what it does is it calculates like what is the exposure you have to ETH from Squeeth, what is the exposure you have to ETH from ETH itself, and which one's bigger. And if one's bigger than the other, then you want to make them be equal, because it's like your exposure to ETH price from Squeeth, you want to be offset by your exposure to ETH price from ETH. So that's basically what we're doing here. It's like we're like looking at like, so like the W Squeeth delta is, if it's greater than the ETH delta, we're basically saying we do a rebalance this way. And if it's less than, then we do a rebalance the other way. Because we basically want those two, like delta means like your exposure to the price of ETH. And so if your exposure from your debt is greater than your collateral, then like you basically like will lose money as ETH goes up. And so you basically need to buy some Squeeth back
And so, but is that sounds different than we also have this concept of like the your debt value in ETH from the controller contract. But that's not this, right? You're talking about a different concept of your ETH exposure.
Yeah, it's different. It's different than the normalization factor. Um, yeah, I mean it's related in the fact that like OSWEET should go down over time, and that's like how this strategy, in a way, that's like how the strategy monetizes funding in the same way that other users monetize funding. Um, but yeah, basically like the movement of the OSWEET price down over time should allow the strategy to basically make money, assuming it makes more from the decrease in the OSWEET price relative to its rebalancing costs as it trades between the two assets to maintain like a flat exposure.
Okay. Um, cool. Well, yeah, we could kind of click around there for a long time uh and I'm sure it'd be interesting, but I haven't prepped enough on all those details. So super interesting. I think coming to the end here, please, people chime in if there's anything we didn't talk about that you want to see talked about. I guess I'm curious what are some other vaults or like things built on Squeeth that you're excited to see?
Yeah, so I think so yes, specifically like on the short side of things. So I think there's like a huge design space in terms of like I think Crab is like kind of just almost an example of something you can build, but you can think about all sorts of things like how frequently you rebalance. Do you always have a short exposure, or do you only go short when funding is above some level? Is it like more active? So like Crab is a very passive strategy. It stays short and it tries to make funding continuously. But you could think of a strategy where you sell when funding is 0.8% and buy it back when funding is 0.3% and like have more active management. You could have a strategy where instead of every day, it like hedges every week, or like, kind of, or every 2 weeks, every 14 days, something like that. Um, I'm also super interested in strategies that aren't flat ETH exposure. So like the Crab is like trying to make dollar exposure, but if you remember when we looked at the different collateralization ratios, you can have some where you're long ETH. So you can create a strategy where the strategy makes money if ETH goes up and it earns funding. So it's kind of like a yielding ETH sort of more strategy, something like that. So or a strategy that's like short ETH slightly, and so you're like slightly negative on it but want to earn funding.
Yeah, I've wondered on those long ones though, because like if you only own as much Squeeth as you have minted from your vault, aren't you basically just like paying yourself? Like you're paying the theta, the decay that you're losing is like proportional to what you've picked up from the increase in price. I mean, yeah, go ahead.
Yes, if you held Squeeth that was equal to your debt, you would like have no exposure to funding. That's definitely true. Um, but yeah, like the way that like a long ETH strategy could be created, like most simply, you could just like add more collateral in, and that would get you slightly long ETH. Like
So
if you wanted to,
like deposit ETH, sell Squeeth, or and sell for ETH and deposit ETH back in, or what would?
yeah, it'd be like instead of so like let's say in our example from before, it's like you deposit 5 ETH, you mint one Squeeth, you sell it for 5 ETH, you put that in the vault, and you have like 10 ETH versus one short Squeeth, right? And that's like our example from before. Let's say in this case, you deposit 10, you still mint one, you sell it for 5, and then you put the 5 in. So now you have 15 ETH versus the same amount of short. So you have more like positive ETH exposure. So you like in dollars, you make money actually if ETH goes up for a while before the Squeeze starts taking over. So it's kind of like
Yeah,
that parable. It's like rotating it. It's basically just like rotating
yeah,
it along.
yeah,
And like what do you want that tangent line to be?
yeah, yeah, totally. Yeah, and again, I think if you want to drop those sheets in the Twitch chat or and I can retweet them on Twitter. I'm sure people would love to see those. Um, somebody asked, and I want to come back to that short vault idea in a second, but somebody asked, so for pricing P&L Squeeth positions, we have to weigh normalization factor, theta with convexity, delta, gamma.
Yeah. So yeah, I mean, one of the things we've been thinking about is like decomposing, like you can decompose the Squeeth P&L to all of those things if you want to. So like you can, you know, try to figure out, what is my delta P&L, what is my gamma P&L, what is my theta P&L, what is my vega P&L? Like there's also a vega P&L here. It's like, and this is like maybe it's a technical question, so maybe an overly technical answer, but like changes in the mark price of Squeeth are fundamentally vega. It's like the implied vol on the Squeeth contract, or the implied daily move, or the implied funding rate is vega. So yeah, you can decompose the P&L into kind of all of those things, and that's something like we're going to work on over time, like making available for people to see, because a lot of people are interested in kind of understanding exactly where everything comes from.
Yeah, I think your idea of the short vault, like arbitraging funding, I think is an interesting idea. Where basically a vault that sits on a certain amount of ETH and like allows anyone to call it and purchase Squeeth if the funding ratio is below a certain amount, and allows anybody to call it and sell Squeeth if the funding ratio is above a certain amount is kind of interesting to think about, and I guess probably have to have certain rescue conditions as well to save the vault, but I guess maybe not. If you're purely just arbing funding rate, you might just be holding Squeeth and ETH, and you might not care that much.
Yeah, I mean, you probably have to think about it. I mean, there's certainly ways that you can lose money doing that, just in the same way that you can lose money on Crab. It's
Yeah.
always ways to lose money.
Yeah. Cool.
Yeah, there's a couple other interesting ideas that we've thought about. You can also look at like long squeeze strategies, which is something we haven't talked at all about, but it's like instead of the downward parabola, just flip it and have like an upward parabola, and it's like you pay some funding and you make money if ETH moves more than is expected. So it's like if you think ETH is going to be very volatile, like that could be a strategy that could be good, and you like try to, it's like if ETH goes down by 10% tomorrow, the strategy will make money, or if ETH goes up by 10% tomorrow.
How would you make money on the downturn? Oh, because you're net up in ETH terms.
Yes, it would be like the same, like you have like zero exposure to ETH price locally. So it'd be like basically the strategy would be like you buy Squeeth and then you borrow some ETH and sell it. So you'd have to like borrow against your Squeeth position.
Yeah.
And then you'd have to like sell some ETH against it.
And
and that would like mean that like locally you don't make money right away when ETH goes up, but because of the curvature, you make money on both sides. To be kind of similar to it's like the reverse of the crab strategy or the short vault strategy, basically.
Yeah. It's again interesting to think about like ways to automate that, of like because I've thought as well. Yeah, I mean, Squeeth is most useful as a long instrument when you're timing it with big market moves, obviously. And most of us just like don't have the time to really watch that or whatever. So it's interesting to think about a vault that maybe just sits on ETH most of the time and then periodically tries to capture a big price move, and maybe that's automated by some on-chain volatility, metrics allow you to trigger that. Is cool to think about. Sweet. Well, I think my brain is pretty full. There's still some people chiming in the chat, so Andrew, feel free to respond to anyone there if you want to. Thanks everybody for attending. I think there's plenty of interest in Squeeth and making more things like this. So I hope Open continues to find more ways to give people ideas and move things along. And I'm happy to play a part in that, and to whatever extent I'm able to. Thanks everybody. Again, this is super informal, just getting started. We'll see where this goes. Let me know if this was fun or helpful. Changes you would like to see. You might need to mute the stream on your. All right. Cool. Let's call it there. Thanks a lot, Andrew.
Yeah, thanks for having me on. This was fun. Don't hesitate to reach out if you want to jam on some more stuff. It's fun.
Sweet. See ya.